Welcome to Portfolio Playbook. I'm your host, Damanick Dantes, founder and portfolio manager at Dantes Outlook. Today, we're looking at the shifting macro signals that shape portfolio construction, from credit market resilience to bond market resets and macro model positioning from some of our partners. I'll walk you through the key correlations and risk considerations that are driving our most recent allocation changes, and then we'll bring it in Victor Zhou to discuss State Street's framework for improving alpha generation, particularly in emerging markets. Our alpha capture portfolio is a moderate risk strategy. It's designed to systematically capture durable trends while actively managing some downside risk. One important correlation that we found is that US equities are more positively correlated with the dollar than our global bond holdings. So in a strong dollar environment, US equities tend to outperform while international fixed income lags. And what we noticed was the dollar's decline this year so far resulted in a -2 standard deviation move from its average levels and has actually shifted from overbought to neutral based on our long-term analysis. So this has led to underperformance in July, negatively impacting our non-US positions. And some of our recent changes have actually neutralized our active tilts to withstand some of these short-term dollar strength. Our allocation shifts, they aim to reduce currency sensitivity, limit our tracking error to the benchmark, and ensure that we remain positioned for both directional trends and range-bound volatility, which typically happens during the summer months. So with all of that, effective August 1st, we made several targeted changes in the portfolio. It's all part of our semi-annual review process. Number one, we replaced European equities with the benchmark's global equity allocation. We've added to US equities to benefit from the short-term dollar strength. We've trimmed our gold and some of our inflation hedges and reallocated that to a broader fixed income opportunity set. We've increased our intermediate term 7 to 10 year US Treasuries allocation and added a global bond ETF for broader duration exposure. That's closer to the benchmark's positioning. And we've also reduced our international treasuries to mitigate some of that currency lag that I mentioned earlier. These adjustments, they keep our systematic trend-based process intact while better aligning exposures with the current macro environment. And here's what came across our desk this week. In terms of credit quality, we've seen some improvements. Morningstar reported that middle market loans in the US, those issuers are showing lower leverage, stronger interest rate coverage, and better revenue growth in Q2 of this year. In private credits, CLO issuance is strong. July was the second busiest month for private credit securitizations this year per Deutsche Bank. And demand from the middle market CLOs is ahead of last year's pace, even with narrowing spreads versus the broadly syndicated loans. That's all pretty positive backdrop for private credit. Given some of the concerns about froth in that space, I think the positive macro environment has been beneficial as of late. Shifting over to the core bond market, there has been a reset. So Deutsche Bank highlighted that the last 5 years delivered the worst rolling 5-year return for 10-year treasuries in recorded history, worse than even post-World War I and early 1980s. That's due to a sharp repricing from the ultra-low starting yields that we've been accustomed to. And now what that means is that valuations for core bonds are closer to fair value, but forward returns are likely to remain low to mid-single digits. And if you think about equities, our high starting valuations, forward returns actually are also mid-single digits. So that's a very interesting forward environment to look into, and diversification might be actually key at that point. What that means is that core bonds are presenting a wider opportunity set. So PIMCO sees that starting yields of 5 to 6% are attractive over the next few years. So you think about total return, and that potential could actually be for double-digit returns rather than what Deutsche Bank is saying if growth slows and central banks cut rates. They also highlight opportunities in international duration due to asynchronous rate cycles. DeepMacro, one of our other research partners, they have model positionings, and they recently showed that the rates model is positioned for slightly higher rates than what the market is expecting, and that's because of stubborn inflation and a hawkish Fed. On FX, they've actually increased their net long US dollar positioning with the UK pound switching from long to short. On asset allocation, they've taken a contrarian overweight to equities, which has paid off recently. Shifting into understanding our trend following nature, it's worth noting that traditional trend following strategies are struggling this year. The SocGen Trend Index is down about 10% year to date. And analysts have pointed out that asset classes like the 10-year Treasury yield have lacked sustained directional trends. We've just been stuck in this broad range for quite a while. It's been tough to find a trend there. That's made it hard for CTAs to build and hold positions. But contrary to that, we take a more of a diversified, systematic approach. So we blend trend, momentum, and relative strength to take advantage of those asset price dispersions as overlays. And that's designed to operate in these choppy conditions without relying solely on single strategy models. So it's a diversification of strategies on top of the diversification of assets. Now I want to bring in our portfolio strategist, Victor Zhou, who's been studying a new State Street framework for emerging market investing. Victor, the floor is yours.
Thanks, Dominic, and thank you for having me here. We have seen emerging markets have changed dramatically over the past 20 years, and China now makes up over 30% of the MSCI Emerging Market Index. India is nearly 20%. And many economies have shifted from export-led to consumption-driven growth models. But the transmission from GDP growth actually doesn't quite relate it to the equity return and causes uneven performance in the equity stock market. Taiwan and India have delivered strong equity gains, while China has lagged despite strong macro performance. State Street's research introduced two important dimensions for emerging market investors. The first is the conceptual activeness, meaning how active your strategy is, ranging from passive index investing to active and fundamental research, as well as systematic strategies. Second, active risk budget, how much tracking error that we can accept versus the benchmark performance. The findings are clear. Emerging market small caps are under-researched. About 50% of the companies have no analyst coverage, and ranging on average, only 6 analysts are covering one company. Second, they offer higher alpha potential and diversification benefits, even when emerging market benchmark underperform. Third, portfolios operating at a higher active levels historically deliver better risk-adjusted returns. So this means combining systematic and fundamental active approaches and incorporating small caps enhances the opportunity set and portfolio resilience.
Thanks, Victor. That's a key takeaway for us. In emerging markets, activeness matters, and small cap exposure can actually help us offset the structural concentration risk that you mentioned. And some of these indexes tend to be large cap dominated, so that makes a lot of sense. And it's a space where we're selectively, can genuinely pay off. We've added some of those active and smaller cap emerging market ETFs to our watch list. So great research there. To recap, here's what we're watching. Currency correlations, they're driving some of our regional tilts as of late. Credit conditions are improving while bond valuations are resetting after years of distortion. And just a side note there, we're actually looking into corporate credit as a way to match our benchmark's shorter term duration while also being conscious of tighter credit spreads. So not just the US actually. So PIMCO made a good point that the global public bond market is so vast. And US-based investors actually get to triple their opportunity set by investing internationally. So if the strong dollar cycle has shifted now to a lower dollar cycle, I think our international opportunity set from a fixed income and equity standpoint tend to be interesting. DeepMacro's positioning is long US dollar. They had a contrarian overweight to equities, and that aligns with some of our tactical adjustments. Trend following remains under pressure this year, making diversification across systematic strategies critical, and that's what we do. In emerging markets, higher activeness and small cap allocations can meaningfully enhance alpha potential, as Victor mentioned. And that's all for this episode of Portfolio Playbook. Thanks so much for tuning in, and thanks to Victor Zhou for joining me. Take care, everyone. smaller cap emerging market ETFs to our watch list. So great research there. To recap, here's what we're watching. Currency correlations, they're driving some of our regional tilts as of late. Credit conditions are improving while bond valuations are resetting after years of distortion. And just a side note there, we're actually looking into corporate credit as a way to match our benchmark's shorter term duration while also being conscious of tighter credit spreads. So, not just the US actually. So, PIMCO made a good point that the global public bond market is so vast, and US based investors actually get to triple their opportunity set by investing internationally. So if the strong dollar cycle has shifted now to a lower dollar cycle, I think our international opportunity set from a fixed income and equity standpoint tend to be interesting. DeepMacro's positioning is long US dollar. They had a contrarian overweight to equities, and that aligns with some of our tactical adjustments. Trend following remains under pressure this year, making diversification across systematic strategies critical, and that's what we do. In emerging markets, higher activeness and small cap allocations can meaningfully enhance alpha potential, as Victor mentioned. And that's all for this episode of Portfolio Playbook. Thanks so much for tuning in, and thanks to Victor Zhou for joining me. Take care, everyone.